Good evening, everybody. Rick Hassey here, week 2 of Accounting and Finance. Welcome. Tonight's study will talk about business transactions, the recording of business events with the ending. What we're trying to get to, I'm lost for words there, is financial statements. To record business events to tell us what happened in a business. The nature of this MBA class is for you, the MBA student, and also if you're a law student as well, is to get and understand the basics of why we have accounting and how that leads into the capital management of a company, finance. Accounting records business events like we're doing tonight and puts those business events into a system of financial statements that tell the reader, be it management, employee, investor, or consumer, how the company is operating. Are they efficient? Are they managed well? Are they making money? Once we have that history of business events and financial statements, then we can go out and attract more capital, more investors. We can grow. We can meet our competition in whatever markets we choose to be in. So for the MBA student, you're getting an MBA degree and a law degree mainly to be a strategist, a leader, responsible for individuals, responsible for corporate or some type of firm strategies of the future to gain value in your business. And in order to be a strategist, in order to be a leader in a company, you need to understand naturally the nuts and bolts of your operation. Why are we not making money? Why do we have too much debt? Why are investors not want to buy our stock? So for the MBA student, these studying accounting and finance is to be able to answer these questions and be a leader. And that's important, naturally. That's why you're studying in a graduate program. So tonight we're going to talk about business transactions, recording business events in the language of accounting, general journal entries, general ledger, trial balance, chapter 2 of your text. You have an assignment posted this week due on Sunday, which goes over chapter 1 and the business transactions that we're talking about tonight. And we'll talk more about assignment 1 a little bit later. Assignment 1 is posted. All the work is to be done on the spreadsheet that is posted with that file. So if you're going to do assignment 1, you download naturally the work files either in a PDF or Word format to get the problems. But then you do all your work on the spreadsheet file and then post that spreadsheet file to the assignment file folder. This is important. One of the reasons why you are in an MBA program is because you have the ability to understand not only business transactions and what they're all about, but also interpreting them in a format that meets the reader's need to understand what you just did. That's why the format of the spreadsheet of recording the events and showing them is important. You do not write them out on a piece of paper and take a PDF, take a picture of it and post the answer. Your job as a graduate student is to do the proper format that the professor desires to show the answers. And that's what we're beginning tonight in the first assignment. Every assignment of this course, you'll be asked to put the answers in a particular format. In the beginning assignments about accounting, it's mainly going to be a spreadsheet. But later on, you'll be doing an analysis in PowerPoint. You'll be doing a paper. So different interpretations and different ways of interpreting and showing your work. And I believe I talked about this a little bit last week. One of the things that drives me nuts about students who graduate with a graduate degree is they have all the knowledge and all the expertise in the discipline, but they can't explain or interpret that to somebody who they're relaying the information to. Can't tell you how many meetings I've been in week to week, year to year with these very smart people who are looking at data, but they can't tell you what the data is telling you or telling us. No, 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 no. So part of the assessment in this course over this next 7 weeks is to make sure, yes, you know how to do a business event. Yes, you know how to do a capital budgeting process. Yes, you know how to interpret a financial statement, but also being able to put it in a presentation that is commonsensical and relates the information that you're trying to show. And I can't stress that enough in this class. Okay, great. We're also going to be doing a couple of problems one that we looked at in week 1, and then one that we looked at this week that tell us and explain to us the basis of these first 2 weeks of our course. It's problem 17A in chapter 1 and exercise 2-8 in chapter 2. These problems are already in your week file folders. Matter of fact, I hope you took a look at problem 17A in preparation for the class tonight. If not, don't worry about it. And we'll look at and process exercise 2-8 tonight in class. We'll give you a fine practice and interpretation of part 2 on the assignment you're working on this week. Okay, so that's the process that are going to be doing tonight. We're going to be, again, looking at the accounting equation and understanding what a business transaction is. And then we're going to be taking those business transactions and post them into the first 3 steps of the accounting cycle: journal entries, posting to the general ledger, and trial balance. Now, again, in the real world, the world that you all are heading in, or many of you already are in business and in department business, in corporate business, the real world, computers do all these transactions. They do journal entries, they post to the ledger, and they do a trial balance. But as an MBA student of accounting, you're learning, first of all, how those transactions get there and what they mean when you look at them in the computer printouts that you might look at in your work. So yes, after this week and next week, you'll probably never do a journal entry in for the rest of your life. But to understand what that journal entry does and interpret the information it's giving you, that's what you'll use for the rest of your life in business. So before I get started, does anybody have any questions or concerns before I get started? You are too easy. Okay. Let's get at her. Here's our file folder from week 1 of last week. And in there was some review exercises, 113, 114, and 17A. Here's it taken from your textbook, which shows you the problems in the textbook, in case we have students who do not have a textbook. Exercise 13 and 14 are pretty self-explanatory, and I'm not going to go over those. You can review those on your own. But the problem we're going to look at tonight is problem 17A, where we're actually doing transactions of a business event in the month of May, and then we're recording those transactions and then preparing financial statements, the income statement, the statement of earnings, and the balance sheet. This gives you a first look-see of taking business events and then putting them in a format that tells individuals, managers, investors, the world, financial statements of what happened. And that's the basics of accounting, is to record the events and show what happened. Now, we're recording the events in the format of chapter 1 that we began to talk about last week, as you can see by the accounting equation. This is just for us to get familiar with how these transactions relate to the accounting equation. But when we get into chapter 2 and we look at exercise 2-8, then we're doing the actual transactions in what is called a journal entry format. And that's what you need to worry about for the assignment of this week. So we're going to start out by doing that. Then we're going to go into week 2 file folder. And we're looking at this exercise 2-8. We'll be doing that in class tonight in a spreadsheet. And there it is right there. We're going to record these events. We're going to post them to the general ledger, and we're going to record a trial balance to make sure all of our accounts are in balance. Exercise 2-8, and that's practice for the assignment that you're working on this week. In that week 2 file folder is a spreadsheet. Exercise 2-8 worksheet in class. If you open that up, there it is right there, a series of spreadsheet equations very similar to the spreadsheet that I give you in assignment 1. And what you want to do if you want to follow along with me in class tonight is go and download this file to your desktop, and you can work the file with me this evening as I'm going through it in class. If you don't want to do that, I will post the solutions to this work that we do in class after class, and you can use that as a template or a study guide for the assignment this week. All right. Okay, now again, what we're concentrating on last week and this week and even into next week, the first 3 weeks of this class is, as I mentioned earlier, the accounting cycle. Tonight, we're doing the first 3 steps of this accounting cycle in class and also on your assignment for an assessed grade this week. We're recording business transactions in a journal entry. We're then posting them to a ledger of accounts that keeps track of all the account balances. And then we're taking those account balances and putting them into a trial balance so we can see that the accounts in our ledger are in balance. There's nothing that drives accountants bonkers than if your ledger is out of balance. You can't go any farther. You can't do the financial statements. You can't go any farther if your ledger is out of balance. So we're doing these first 3 steps tonight and this week in assignment number 1. Okay, so that's where we stand. Okay. Now let's get out of this. And go to this. Okay, this is the problem we're going to do right now. It was posted last week. It's a series of transactions for Gabby Graham, who started the Graham Company on May 1st. Graham Company completed the following business transactions for their first month of doing business as a company, May 1st to May 31st. What we're required to do in this problem is put these transactions not in a journal entry, but in the accounting equation that we began to look at last week. Once we put all those into the accounting equation, then we're going to summarize all that activity into the income statement, the statement of retained earnings, and the balance sheet. For this problem and this few weeks, do not worry about the statement of cash flows. We'll do the statement of cash flows later on in our course. Right now, we're just concentrating on the big 3: income statement, statement of retained earnings or owner's equity, and the balance sheet. So we're going to be recording this business event so we can get a feel of how these transactions relate to the overall accounting transactions of a company. Okay, so here they are. Here's the solutions that I gave you for this problem. Okay, I'm going to read through the transactions and I'll show you how they relate to the accounting equation. Remember, I know this is going to be boring for some of you. I'm sorry. But for some of our students who have not much experience in accounting, this is a good way of understanding the flow of the accounting equation and how transactions relate to the overall big picture of the company. And that's why we do it in this early stages. On May 1st, the owner of the company, G. Graham, invested $40,000 in the business in exchange for common stock. We talked about this last week. Remember, in accounting, for every business event or every business transaction, there is at least two things happening because one side of the account always has to equal the other side of the account. So notice the May 1st transaction here. The owner put $40,000 into the business. Cash is increasing by $40,000. At the same time, there is now an equity account position created, $40,000, and we're calling that common stock. Okay. If you ever invest in a startup company, in an IPO, an initial public offering, and you give a company $40,000, and in return they give you stock in the company, that's exactly what's going on here. The company is taking your money and putting it into their checking account. Now they have cash to begin operations of their business. At the same time, that $40,000 represents your ownership share of the company. Also on May 1st, the company rented office furniture and paid $2,200 as rent on that office furniture. Okay, here they're spending cash, $2,200, so cash is going out of the business. At the same time, what is being provided the company? Well, money is going out of the business to get office furniture. Excuse me, rent an office, not office furniture, renting an office. And so naturally you call that an expense, rent expense. And notice the equity of the position of the company is being reduced. Money is flowing out of the business in the form of cash and in the form of a rent expense. The next transaction, we purchased equipment of $1,890 on credit. Even though we're not paying out cash, we are still owning equipment. So equipment under assets is being increased by $1,890. At the same time, we now owe $1,890 in accounts payable. We owe the money. So our liability position of the company has increased. At the same time, we have acquired a new asset called office equipment. And why is it important to record the asset in a separate account like equipment? Well, we'll find this out in chapter 3 when we have to depreciate the assets of our company. So you have to know you don't depreciate cash, you don't depreciate accounts receivable, that's money owed you, but you do depreciate the use of assets like equipment over time. So we have to keep separate the asset of equipment because we're going to have to depreciate those assets in what is called adjusting entries, but that's in chapter 3 and part of our discussion next week. May 5th, the company paid $750 for cleaning services. Again, see that the $750 of cash is being spent, reduced. At the same time, the equity position of the company is being reduced in the form of cleaning expenses. Money is going out of the business. Here, money is coming into the business in the form of equity ownership. Here, money is staying in the business because we haven't spent any cash, but we owe the money. So these are common concepts used in the beginning of learning about accounting transactions. On May 8th, The company provided consulting services for a client and collected $5,400 in cash. So now we have our first revenue transaction. We provided a service, a consulting service. We billed the customer $5,400 and they paid us immediately cash. We took that cash and put it into the bank account. Notice cash is being increased $5,400. And now money is coming into the business in the form of additional equity called revenue. Remember when money was going out of the business in expenses, that's a reduction of equity. Here, money is coming into the business called revenue, and our equity position is increasing. The business is richer or has more value. Revenue. Those are perfect examples in these first couple days of this business operation of money going out, expenses, rent, and cleaning, money coming in, revenues, consulting services. And then on May 12th, we have an additional consulting services, but this time the client is billed and we provide the services on credit. So instead of receiving cash like we did on May 8th, we receive now an invoice, accounts receivable. They now owe us the money. At the same time, it's still revenue. And the equity position is increasing for additional revenue of the consulting services provided. But this is an important point for especially first-time accounting students. We provided two different types of services. Consulting for cash, consulting billed. They're still revenues. One is in the form of cash, one is in the form of a receivable. They have 30 days to pay us. May 15th, the company paid $750 cash for an assistant's salary for the first half of the month of May. Notice we paid the assistant their salary minus cash, $750. And again, over here, this is an expense called wages or salary. Money is leaving the business to this assistant's salary minus $750 expenses. Now you're beginning to see what makes up our income statement, the difference between revenues collected and expenses incurred in providing those revenues. The difference between these two columns is our income statement. And we'll see that in just a minute. Clear as mud, huh? Okay. May 20th, the company received a $2,500 cash payment for services on May 12th. Well, remember on May 12th, we billed a customer consulting services and we recorded the revenue. Now, 8 days later, they're paying the amount they owe us. So we're receiving cash. At the same time, they're paying us that invoice. So that's wiping out the receivable. Notice, no revenue is received. This is not additional services provided. This is paying a receivable owed us. So there's no effect. The net effect on the accounting equation is zero, but we're receiving cash and decreasing receivable. May 22nd, provided $3,200 of consulting services on credit. All right. Again, just like we did on May 12th, $3,200 of receivable is booked for services revenue, $3,200. Again, we provided a service, we're just not getting cash. They owe us the money. They have 30 days to pay. As many of you know in business, many customers are going to do business with us, especially if they have some time to pay us what they owe us. Why do you use a credit card when you go to Costco? Well, you can buy services at Costco and you don't have to pay them for 30 days when you put it on the credit card. And this is what credit is. It's giving you the ability to provide a service and have 30 days of the customer to pay for it. Thus, you're going to attract some business. Then on May 25th, that $3,200, That $3,200 is paid, just like it happened on May 20th. Again, we receive the cash. The receivable is now reduced. The bill is paid. Notice, no additional revenue is received. May 26th, the company paid $18.90 for cash for the equipment purchased on May 3rd. Remember back on May 3rd, we bought some equipment on credit and we went into what is called accounts payable. We owe the money. Now we're paying that bill 23 days later, reducing cash and wiping out the payable. We no longer owe that payable because we're paying it minus cash minus the liability. May 27th, we purchased $80 of equipment on credit. Again, we buy additional equipment, credit $80, and we owe the money. The payable or the liability is increased. And then the final last few days of the month, we're paying expenses. May 28th, an additional salary expense is being paid, reducing equity expense. May 30th, we're paying for the telephone bill for $300. That's called a telephone expense. May 30th, we're paying the utility bill, $280. And that's an expense going out of the business, $280. And then finally, the last transaction, whenever you have common stock, usually the company is going to give the owner of that common stock a reward. It's called dividends. And notice on May 31st, at the end of the month, a dividend is declared of $1,400 cash payment, and you record that as a reduction to equity called dividends. So cash is being reduced, and the final equity account, dividends or distribution of money to the ownership, is $1,400. So if you go through now, you total those accounts up, $42,780 in cash, $1,970 in equipment, $80 in payable, $40,000 in common stock, $1,400 negative in dividends, an additional $11,100 in revenues, and reducing equity by $5,030 in expenses. What we just did here is the accounting cycle. We recorded the business events, we found the ending balances in the accounts, and now we're going to prepare some financial statements that tell us and summarize this activity. The only difference between this and what we're doing in Chapter 2 is we record these events not under a category or a formula like this, but we record them as journal entries. Note, May 1st, the journal entry would be debit cash, credit common stock. May 1st, debit expense, credit cash. May 3rd, debit equipment, credit liability. May 5th, debit expense, credit cash. May 8th, debit cash, credit revenue. That's what we're doing in Chapter 2, and we'll practice that on a little bit later this evening. But we're going to put these transactions into a debit and credit formula. Notice a couple of things of what I just said. Debits are increases to cash. Credits are decreases to cash. Debits are increases to equipment or assets. Credits are increases to liabilities. Credits are increases to equity. Debits are decreases to expense. Credits are increases to revenue. Those are important concepts that are talked about in your textbook, but to be perfectly honest with you, and I kind of apologize for this, the textbooks makes this look very confusing. It's like, what the hell are they talking about? But that's pretty well summarizes the transactions of how we're going to record them in Chapter 2. But more about that in a little bit later. Now, if I take all those transactions for this company for the month of May, all right, we have all the balances and all the particular accounts. Where do all these balances go? Well, the first stop is the revenue and expense accounts. Revenue and expense. Notice right here, the income statement. Income statement is a statement of revenues and expenses for the month of May. Here are the revenues, 11,100. Here are the expenses, 50,030. And that the income statement tells the reader, oh, we collected $11,100 in consulting services, and we collected rent expense, salary expense, cleaning expense, telephone expense, utility expense, 5,030. Hey, we made money last month. We made a profit of $6,070. This is why we do financial statements. Can you imagine if this company was Walmart and all the transactions for the month of May are listed here? There'd be thousands. No way could you get an idea of what happened in the month of May. But by taking these account balances and putting them to the format of a financial statement, it tells the reader, yeah, we had a good month. We made $6,070 revenue minus expenses. Now, the profits of the company lead into the next financial statement, a statement of retained earnings, how much money we've retained at the end of the month of May. And the statement of retained earnings is taking if there was any beginning balance at the beginning of the month, which there was none, since this was the first month of operations of this Graham company. There's the profit we made from our income statement, 6,070, and then we subtract out the dividends of $1,400 that we paid the owner. And so we ended up retaining $4,670 of our profits by the company. We made net income of 6,070. We paid some of that out in the form of dividends. So our net retained earnings is 4,670. And notice where that number ends up on the balance sheet. Under the equity section, retained earnings 4,670. So again, you're beginning to see a pattern here. The income statement, bottom line, leads into the statement of retained earnings. The statement of retained earnings, bottom line, leads into the balance sheet. And those are important concepts in the financial statements. Remember, the balance sheet is a statement of assets. Here are the assets: cash, 42,780, and equipment, 1970. And there they are right there. Here's the asset position of the company on May 31st. Note total 44,750 of assets. What are the liabilities? Looks like we only have one. Accounts payable, $80. And there's our liabilities, $80. This is the amount of money we owe at the end of May. And notice the equity section. The equity section is a statement of our common stock and our retained earnings, revenue and expenses, and dividends. And that's why we do the retained earnings statement. So notice under equity, there's the common stock, there's the retained earnings, there's the total, and golly gomer, assets equals liabilities plus equity. We're in balance. Fini. We now have described the first month of operations for this company, the Graham Company. They made a little bit over $6,000 in profits. They retained after dividends $4,670, and their asset position of things that they own is $44,750. They have a very small debt position of only $80 that they owe, and so it's mainly an equity position of the company, the value of the common stock, the book value of the common stock, and the retained earnings position. Thus, there's the companies. Every company that you all selected this first week in our discussion forum, Melissa selected Edison International. Ying selected Tesla. Alexandra selected Apple. Jinyu selected Tesla. Carlos selected Walmart. Thomas selected NVIDIA. Victoria selected Lululemon. I probably screwed that one up. And Jason selected Google. And Miss Zing selected, I don't know what they selected. I got to figure that one out. New student. So all those companies, their financial statements look exactly like these one, except the numbers are just bigger because they're big corporations. But every company in the world does their financials just like that. One of the things, if you have some spare time in the next week or next weekend, is go to the companies that you selected and go to their financial statements. You can do that by going to the company's website. You can go to Yahoo Finance and take a look at their financial statements. Take a look at their financial statements. One of the things you'll notice is, these are a lot more confusing than problem 1-7, but they all are exactly formatted the same. The income statement tells you the profits or losses. The retained earnings statement tells you the retained earnings retained by the company. And the balance sheet is a statement of assets, liabilities, and equity. Every one is exactly that format. And we're going to be doing some work down the road on taking a look at your companies and their financial statements. Okay. So that's problem 1-7. That's a great review of the basics of accounting. Now we get into chapter 2. So let's take a look at that one. So again, one of the highlights that we're trying to do in these first couple of weeks, as I said earlier, is to make sure that we want to show the financial statements of a company, identifying the transactions and business events of the company, and putting them into a general information or ledger accounts and taking that ledger, preparing a trial balance, and then from the trial balance, we know everything is in balance, we prepare the financial statements. So that's what we're doing now. This is the basis of all accounting record keeping. The general ledger is a record of all accounts used by a company. What's an account? Well, account is what we just looked at in 1-7. Cash, receivable, equipment, accounts payable, common stock, revenue, expense, dividends. Those are all examples of accounts. And you keep track of those accounts in what is called a general ledger. We're going to be looking at that process in the exercise we're going to be doing a little bit later. These are all the different types of accounts. Assets, things that you own. Liabilities, things that you owe. Now, this is anything with a payable is pretty self-explanatory, but look at this one account here, especially for you law school students in the audience, and you know who you are. Unearned revenue. I can't tell you how one of the first things you do when you go talk to a lawyer about doing some business with the lawyer, the first thing the lawyer says is, you have to give me a retainer. Damn it. Before you do anything, you have to pay the attorney a retainer. And you might say, wait a minute, why am I paying you now? You haven't done a damn thing yet for me. Well, in our business, we have to have a retainer to make sure that you have goodwill and are going to accept the services that we provide, your attorney fee and lawyer fees. So you have to pay a retainer. So let's say I go to a lawyer and lawyers, I like you to do some legal work. I like you to put together my will for my family. Okay, the lawyer says that's going to cost you probably about $2,000, $3,000. I want a retainer of $1,000 before I start putting your will together. All right, that's fair. So you give the lawyer $1,000 as a retainer. You give them the money. When that happens, the lawyer is not creating any revenue for his or her law firm. Why is that not revenue? Because they have yet to do any legal service for you. It's called unearned revenue. You give $1,000 to an attorney, they now owe you at least $1,000 of legal services. So they owe you. That's why it's called a liability. When you pay in advance for a service, they now owe you that service. And that's a form of liability for many businesses. Guess what? Here's something surprising. One of the biggest scams in the history of mankind is paying up front for your MBA classes. Wait a minute. I got to pay in, what's this, June? I got to pay in May and June before my summer classes? Yes, that's how it works. We want your money up front. But when you give your money to Laverne to pay for this class in May or June, or if it's charged to it for a loan, or if you get a scholarship or whatever, that is not revenue yet. It becomes revenue once the classes are provided you. So when you first give money to Laverne for a class, that goes into an unearned revenue account. Laverne now owes you the service of paying for that class. And then once you satisfy the first 3 weeks of the class and the class becomes an official class, then that unearned revenue becomes earned revenue. So that's a liability account that a lot of people are not too familiar with. And then we have the equity accounts that we just talked about. Owner capital, or if this was a corporation, common stock. Owner withdrawal. If this was a corporation, that is called dividends. Revenues are increases to equity. Expenses are decreases to equity. So here's a ledger. The ledger is a bunch of accounts, each with a debit and a credit side, a left-hand side and a right-hand side. Every account, cash, revenue, expense, payables, equipment, all has a two-side account. Left-hand side, right-hand side, debit, credit. If there's one important screenshot in this chapter 2, it's this one right here. Make a copy of it, highlight it in your textbook. This gives you the basics of how these debit and credits fit into the accounting equation. As I said earlier, notice debits increase assets. Credits decrease assets. Credits increase liability. Wait a minute, Mr. Hassey, time out. You just said on assets, credit decreases assets. Now you're telling me in liabilities, credits increase liabilities. Yes, and here's the reason why. Look where assets are in relation to the accounting equation. Assets are on the left-hand side of the accounting equation. Everything is opposite on the right-hand side of the accounting equation. Where on the left-hand side are assets, credits decrease assets. On the right-hand side of the accounting equation, credits increase debt and credits increase equity, the direct opposite. Notice on the left-hand side, debits increase assets. But on the other side of the accounting equation, debits decrease liabilities. When you pay off liabilities, you decrease them. And debits decrease equity. That's why expenses are always debits. That's why dividends are always debits. Notice it's the direct opposite on each side. You get that figured out, this is a no-brainer. But a lot of students have a lot of difficulty understanding, Mr. Hassey, why am I debiting this and crediting this? It doesn't make sense. Well, that's where it's explained to you right there. So yeah, I want you to do something. If you have a friend, a family member, somebody at work who does accounting, Go up to them this week or in the next few days and say, hey, guess what? Debits increase assets and debits decrease liabilities and equity. And they'll go, damn, you know accounting. You must have HASI as a professor because you now know accounting. That's it, basically. Alexander, you're supposed to laugh at this. This is a joke. It's not that serious. You're supposed to laugh at this. All right, Victoria, laugh at this. This is relax. This is something easy. All right. So that's a key part of accounting. This one slide here. All right. And then it goes on to, I want to jump ahead because we're all going to be doing this in the next exercise. Here is what a general ledger looks like. We're going to be putting this together in exercise 2-8. Notice all the transaction of cash for the month are highlighted, debit transactions and credit transactions. You take the difference between the two columns, that's the account balance. And notice every account has their postings to the general ledger that summarize the activity in the month. This is called the ledger. Again, in the real world, this is all done by a computer. And then once you have those ledger balances, then you record them in what is called a trial balance. Let me go back here. See this ledger here? Cash is $42.75, the difference between debits and credits. Supplies is $97.20, rent expense is $1,000, and so on. Look at these now are listed in what is called a trial balance. This is a listing of all those ledger balances. And notice if you total them all out, the debit balances versus the credit balances, $45,300 total debits, $45,300 total credits. I'm in balance. That's why you do the trial balance. It tells you that your ledger, your accounts are in balance. This is what we're doing this week in chapter 2. Journal entries, general ledger, trial balance. Okay. We're going to take a little break, about 10 minutes. I want to see the score of the hockey game. No, only kidding. No, not really. All right. When we come back in 10 minutes, what we're going to do is we're going to take a look at this problem. Exercise 2-8. You might want to get a head start and take a look at it or download the Excel spreadsheet that we're going to put the answers on. We're going to do this exercise 2-8. We're going to prepare journal entries for the month of June for Sustain Company. We're going to record the journal entries, debit, credits, debit, credits. Then we're going to take those journal entries and prepare a general ledger for that company for the month of June. And then once we prepare the general ledger, we're going to prepare the trial balance of the company. That's what chapter 2 is all about. That's what you have to do in assignment 1. This is perfect practice to do that. So we're going to take a look at this exercise when we come back from break in about 10 minutes. So let's take a break. Smoke them if you got them. Let's have a sandwich. Let's have a beer. Let's have a glass of wine. I know Melissa is anxious for a glass of wine. And now and then we'll come back at 7:05. I'll see you back here at 7:05.
Hey, Professor Haas.
Yes, sir.
Panthers are up. Who's that?
Damn. Okay, good. Thanks. Thank you very much. Well, I want Florida to win, but I didn't think they'd be up that quick that early. That's pretty good. Okay. Thank you, sir. All right. See you at 7:05. Adios. Get out. Leave. Okay. You know, they don't make music like that anymore. Okay. Mr. Griffin, Jason Griffin, what's wrong with your camera? What's going on there? Are you with me? Mr. Griffin? Bueller? Bueller?
Just for that, sir. My laptop is hooked up to a docking station, which means it has to be closed. So I need to get an external webcam. I'll be picking one up tomorrow afternoon. So
Well, don't go and buy one just for this class. That's stupid. As
oh,
long
no,
as
no, no.
as long as I understand that, that's okay. Just don't don't go out and buy that unless your last name is Buffett or somebody like that. Don't go out and buy something like that. That's just for this class, Jason. Don't worry about it.
No, they're only like $25 at Best Buy. It's not that big.
Okay. All right. Well, you make that decision, but don't. I hate you guys pay enough money for these classes. I don't want you to go spending any more.
Oh, no.
Okay. So let's take a look at a problem that summarizes these first 2 weeks of our class. It's exercise 2-8, where, as you can see, this is the spreadsheet that I provided in week 2 that is very similar to the spreadsheet I provide you for assignment number 1. And what we're going to do is we're going to record journal entries of these transactions in the month of June. Then we're going to take those transactions and post them to a general ledger. And I have the ledger already set up. And then we're going to take those ledger balances and put them into a trial balance so we make sure that now we know everything has been balanced and we can continue on with the accounting cycle. So the first transaction we're looking at here is on June 1st. T. James, the owner, invested $11,000 cash in Sustain Company in exchange for common stock. So if I was doing a journal entry transaction to record this transaction, I would put in the date, June 1st. I would put in the account cash, debit $11,000. And right underneath that, I would put in the credit account, in this case, common stock, credit $11,000. All right. That's the journal entry for that June 1st transaction. If at the same time, I would now post this transaction to the general ledger, putting $11,000 on the debit side of the cash account and putting $11,000 on the credit side of the common stock account. And this is exactly what computers do at your company every day. You record a business transaction and immediately the computer puts it in the proper ledger account like we just did. This is recording the journal entry and posting to the ledger of accounts. Let's look at the next transaction. June 2nd, the company purchased $4,000 of furniture made from reclaimed wood on credit. So on June 2nd, they bought furniture for $4,000. And it's on credit, so it's got to be accounts payable. They owe the money, $4,000. There's the journal entry for buying a new asset, furniture. It doesn't sound like much of an asset with unclaimed wood. Ugh. But whatever. They bought the asset on credit, so they owe the money, $4,000, accounts payable. So now I'm going to post that to the general ledger. Where's the furniture account? There it is right there. I post the $4,000 on the debit side. And under accounts payable, I put the $4,000 on the credit side. Now, if we want to be fancy, we can put in the date like June 1. But I don't see that's necessary because we had the date in the journal entry. So don't worry about the dates in the ledger. All you do is just post them to the proper side of the account. Okay, June 3rd, the company paid $600 cash for a 12-month prepaid insurance policy on the reclaimed furniture. So we took out an insurance policy on our asset. Now, this is where you have to put on your thinking cap, and this is where it pays to read the textbook for Chapter 2, or it pays to look at the PowerPoints of Chapter 2 before you come to class. Because it's saying that we're paying on June 3rd $600 cash for a 12-month prepaid insurance. We're paying in advance for the insurance. So on June 3rd, the debit is what is called prepaid insurance of $600, and the credit goes to cash, $600. We're paying the insurance policy in advance. So why? That's why it goes into a prepaid account and not an expense account, because as of June 3rd, the insurance has not been provided. We're paying in advance for it for 12 months ahead of time. And this is what we'll see when we get into Chapter 3 next week. This is why we have adjusting journal entries, where we have to adjust prepaids as they become expenses. But we'll worry about that next week. But in this case, we're putting that $600 of spending cash into not an expense account, but an asset account called prepaid insurance. The key point here is the insurance has yet to be provided us. We paid in advance for the policy. The insurance company owes us the service. June 4th, the company billed a customer. Let's post that to the general ledger. Sorry. Prepaid insurance on the debit side, $600. And now we'll put $600 on the credit side of cash because we paid cash for that prepaid. So now we've posted that to the journal, to the ledger. Everybody okay so far? Ying, okay? All right, good. June 4th, the company billed a customer $3,000 for services provided. Well, now we have our first revenue for services provided, and we billed them. So we're going to have accounts receivable as a debit. We billed the customer $3,000. They owe us the money. At the same time, we now have provided revenue, a credit of $3,000. The key thing here is we provided the service, but we billed them. They didn't pay us for it yet. They owe us, they have 30 days probably to pay the bill. So it goes into the asset accounts receivable. So let's put that into our ledger. Accounts receivable on $3,000 on the debit side, and revenue, service revenue, $3,000 on the credit side. So we've now posted the general ledger. People do this for a living and get paid very well for it. It's not too exciting though, is it? All right.
Professor.
Yes, sir.
The last page.
Yep.
Yeah. Why sometimes put the left side on, and sometimes we put the right side?
Let's take a look at cash. Here we're receiving cash in the business of 11,000.
Thank you.
Here we're spending cash, 600. So it goes, when we receive cash, it's a debit to the cash account. When you spend cash, it's a reduction or credit of the cash account.
Thank you, sir.
Okay, good question. Thank you. June 12th, the company paid $4,000 cash toward the payable of the June 2nd furniture purchase. So remember, on June 2nd, we bought some furniture on credit. Now on June 12th, we're paying that liability. So we're going to debit accounts payable $4,000 because now we're paying the liability. And how are we paying it? We're paying it with cash credit, $4,000. Remember here, we credited accounts payable because we owe the money. Then 10 days later, we pay the bill, debiting accounts payable and paying it with cash. So now we post that to the ledger. Accounts payable now is going to be debited $4,000. So we know that account is now paid off, and cash is credited $4,000 because we paid the debt. Now we've posted that to the general ledger. June 20th. The company collected $3,000 cash for the services billed on June 4th. So on June 20th, we're now the person who we sold those services to is now paying us the receivable. So cash is being received, $3,000, and accounts receivable will be credited because they're wiping out the bill that they owe us. All right. Here, accounts receivable was debited, service revenue credit. Now, 8 days later, or yeah, 8 days later, they now are paying us cash for that receivable, and we wipe out the receivable balance. They no longer owe us the money. So let's post that to the general ledger. Cash, $3,000 debit, and receivable, $3,000 credit. So now we know we've paid off the receivable and we got the cash. Notice here the general ledger summarizes all the activity of all these journal entries into one by account so you can see the activity during the period of time of these particular accounts of the business. June 21st, T. James invested an additional $10,000 cash in the company in exchange for common stock. So another owner investment in the company on June 21st. Invested cash, just like we did on June 1st. In this case, it's $10,000. And now there's more common stock equity created, $10,000. And now we post that, $10,000 additional cash coming into the business. And we go over to common stock. And now there's more equity position in the company. The owner has now invested $21,000 into this corporation of the business, providing it with cash that probably they're going to use in later months or weeks to run the company. And then finally, on June 30th, the company received $5,000 cash in advance of providing services to a customer. And this is like what we talked about earlier about law firms, when they charge you a retainer in advance before providing the service. Well, here in this transaction on June 30th, they're receiving $5,000 in advance for providing services to the customer at a later time. So cash is being debited because we're receiving cash, $5,000. And at the same time, we now put it into an unearned revenue account, which is a liability account of $5,000. And we'll post that to the general ledger, $5,000, cash, and unearned revenue, $5,000. The month of June is completed. Here's the journal entries for the month, a recording of all the business in accounting language, debits increasing some accounts, debits decreasing other accounts, credits increasing some accounts, credits decreasing some accounts. And then we take those transactions and put them into a ledger. And now we're going to determine the account balance of this company. What is the account balances in each one of these ledger accounts? So for cash, since there were so many transactions, let's total up the debits, 11,000, 3, 10, and 5. That totals $29,000 of debits. Let's total up the credits. That's $4,600 of credits. So what's the account balance? The difference between the debits and the credits. $24,400. That's the cash account balance at the end of the month of June. All the increases to cash, all the decreases to cash, that nets out to $24,400. That's the general ledger cash account balance. Accounts receivable, one debit, one credit, that's easy. A zero account balance. Office supplies, nada. Haven't spent any yet. Prepaid insurance, one transaction with a debit balance of $600. Debit balance. Furniture, one transaction. Get that out of there. A debit balance of $4,000 in insurance and in furniture. Unearned revenue, one transaction, $5,000 account balance. Accounts payable, zero. We owe nothing. Common stock, here's a big one, $21,000 account balance in common stock. Service revenue, we provided one transaction for revenue, $3,000. So those are all the general ledger balances. Some are debits, some are credits. This summarizes all the activity by account for the month of June. So the last thing, or first of all, whenever you're doing these transactions in a spreadsheet, always save them. Don't do the whole problem and then forget to save it, and then something goes wrong and you got to do it all over again. So always make sure you save your work during the process of doing this information. Can't tell you how many times I've done that in my life. Ugh. Okay, so now we can take these account balances and list them in our trial balance. Cash, $24,400. Boom. That's taken right off the ledger. Accounts receivable, zero. Office supplies, zero. Prepaid insurance, $600. Okay. Furniture, a debit balance of $4,000. Okay. Unearned revenue, a credit balance of $5,000. Okay. Accounts payable, zero. Common stock, a credit balance of $21,000. And then finally, our revenue credit balance of $3,000. Now the moment of truth. What's the total of each column? And hopefully they're equal. Now I'm Catholic, so whenever I do this transaction, I always say a little prayer, making sure I didn't screw up and everything is in balance. But let's keep religion out of this class. I'll get people mad at me. So here we go. We'll do the sum. We'll summarize each column. $29,000. Okay. $29,000. My trial balance is in balance. I am cool. End of the process. Those are the first 3 stages of chapters 1 and 2 of the accounting cycle. We've recorded the business events of this company, the sustained company, for the month of June. We put them in their proper ledger accounts, and now we've summarized those ledger account balances in the trial balance, and now we know everything is cool. Now, what we could do now is prepare financial statements if we wanted to. The income statement would be pretty simple. Revenue of $3,000 and no expenses. The retained earnings statement would be pretty simple too. Profit of $3,000. The balance sheet would have assets of $24,400, $4,000, and $600, and the liabilities would be unearned revenue of $5,000. The equity would be $21,000, and the profit that we've retained. The balance sheet would be $29,000 as well. But we're not asked to do that. This is as far as we're going through chapter 2 for this week. I will be posting this solution file back to week 2 after class tonight. But this is exactly what the textbook is trying to confuse you with in their work. The biggest thing, or the biggest challenge for you all, is making sure you understand why I put certain transactions in a debit column and why certain transactions went into a credit column. And the purpose of that is so that everything balances out and we can move on with our recording accounting events. Anybody have any questions about this problem? You are now official accountants. Thank you very much. You have now witnessed the accounting cycle and what needs to be done to record and process accounting events, business transactions. And that leads us to this. Your assignment for this week, which represents 10% of your course grade, due on Sunday at midnight. Now, remember, I talked about this last week. If you need extra time, no problem. The reason why I have the work due on Sunday is that so I can grade it on Monday and have it ready to review and process in the class on Tuesday night. But if you need extra time, all you do is let me know, Mr. Hassey, I'm going to post late Monday. Mr. Hassey, I'm out of town. I got problems, or I'm backed up. I'll post this on Tuesday. That's no problem. Just let me know. You won't lose any points. It won't affect your grade whatsoever. Now, for this assignment, it's not that difficult. So I would think most of you could wrap this up in maybe an hour or so. Now, the multiple choice questions could be a little bit challenging. They're taken out of our lectures in the class the first 2 weeks and taken out of the material in the textbook. So some of you might have to look up some of the answers, but that's good. The process of looking up will help you learn the definition. But the first part 1 of the assignment, is 20 multiple choice questions that define accounting from chapter 1. Okay? 20, each problem is worth 2 points, 20 multiple choice problems. So what you'll do, and I'll show you where this is in the D2L platform, but what you do is you'll go and download the assignment 1 worksheet. The first tab is multiple choice, and you'll download that, and then you'll answer the multiple choice questions here. Put in the letter of the problem on this worksheet. So you can download the files in two different formats. Some students like downloading PDF, some students like downloading Word. Now, the spreadsheet, let me go back to that. The spreadsheet is in Excel format, but if you have a Mac, you can download the spreadsheet. I'm sure all of you have in your Mac software that can convert Excel into numbers, or it can just look at Excel in your Mac. That's not a problem. But if you do the spreadsheet or convert the spreadsheet from Excel to numbers, when you're all done, save it back as an Excel file before you post to me. I'd like to have all the files in Excel. It just makes it easier and quicker for me to grade. If some of you post a numbers file, I got to go back into my Mac and download it, and slows down the process. So I'm being kind of selfish there, so I apologize. But here's where you put the answers for the 20 multiple choice questions. Then you go to part 2 of the assignment. Here it is right here. Accounting transactions. This problem is worth 60 points. 20 points for the journal entries, 20 points for the general ledger, 20 points for the trial balance. So here it is. This woman is opening up a web consulting business, and here's the month of April, the transactions April 1 through the 29th of her company for April. I give you a listing of the accounts to use in this problem. Your job is to record the journal entries of each one of these transactions, just like we did in exercise 2-8. You have to interpret the transaction, put it as a debit and credit in the proper accounts. So we go back to our spreadsheet worksheet, and you go to tab 2, journal, and here's where you record the journal entries for those transactions April 1 through April 29th, just like we did in exercise 2-8. Okay? And then once you do those transactions, or you might do one after another, you post those to the general ledger. And I have the general ledger all set up for you. Thank you, Mr. Hasse. And so now all you have to do is take those journal transactions and post them to the appropriate left-hand or right-hand side of each column. After you're done posting, then you'll have to calculate the account balances. And when you get the account balances done in the ledger, then you go to the trial balance and put those balances in the appropriate area. And I've already listed the accounts. And those totals should equal, just like we did in exercise 2-8. 20 points for the journal entries, 20 points for the ledger, 20 points for the trial balance. 40 points, 2 points apiece for the ledger. So when you get this problem all done, got everything done, then you save it in your name. So you save it to your desktop or save it to your flash drive and put your name. Ding, assignment 1 worksheet. Put your first name there. Then when you save it, you'll take that file. You'll go into the D2L, and let's go to that. You'll go into the assignments folder. You'll see assignment 1. You click on it. And what you do here is you want to add a file. So you click on add a file. You go to your computer. You find the name of the file. When you upload and you find the name of the file on your flash drive or on your hard drive, wherever that file is located, you click on it. And then you hit add and it uploads. So now I can grade it. And then you might say, Mr. Hasse, you are brilliant. And that'll help you in your grade calculation, I assure you. But the key thing to do is once you add the file and upload it, you hit submit. If you don't submit it, I'll never get it. You hit submit, and then I'll have it ready to grade. And then when we're done, I'll grade it and return it back to you in your grade center with the grade and any notes I might put on your work. But you're only going to upload the one file, the worksheet file with your name in the title of your work in this file folder. Multiple choice answers, journal entries, ledger postings, and the trial balance. Ladies and gentlemen, that is assignment 1 for the first 2 weeks of our accounting finance class. So the cool thing about this is you're going to upload everything to the assignment 1 introduction. I don't want, because you're graduate students here, so I'm going to kick your butt if you don't do this right. Sorry. I don't want any student saying, Mr. Hasse, I couldn't figure out posting it. Here's an email with the file attached. I will not grade that file. You have to post all your work in D2L to this file folder. If you give it to me in any other format, 0. If you send me a PDF file, if you send me a non-spreadsheet file, 0. All right, so everybody got that? This is graduate school. I'm not going to burp you and hold your hand and make sure you do it correctly. You have to do this correctly. The correct file is the worksheet Excel file that I provided. All your work is on that sheet. It's already formatted to do it. You save it and you upload it, and there's your work. You don't take pictures of it. You don't do a PDF. Nada, nada, nada. If you send me an email, even though you might have it all right, you'll still get a 0. The key thing, as I mentioned earlier, is as a professional student, graduate student, you have to do the proper format that the instructor demands, which represents the interpretation of the study and the work. In the assignment 1, the format is a spreadsheet file that I provided. Any questions on how to do this? Now, if you run into problems, something goes wrong, let me know. Just don't assume I'm telepathic and I know why you sent me an email with your problems. That ain't right. If you cannot upload the file, get a hold of me immediately. Say, Mr. Hasse, I got a problem. So I'm going to email you to work. Nope, you're not going to email the work. You're going to solve the problem. If you need my help, you'll solve the problem. Everybody got it? All right, cool. It's pretty straightforward. Not too much to worry about. Let me just something here. Okay. You download the file. Oh, I didn't show you where those files are. Let's go back to that. Here are the files. Here's a Word doc file and there's a PDF file. You just right click them and you can download them to your desktop, and there's your work file to do the spreadsheet and put the answers on that I gave you. Okay? And that summarizes our first 2 weeks. Next week, in week 3, we're going to talk about adjusting journal entries and preparing the final trial balance to do the actual financial statements. And that'll be the next assignment number 2, where you actually do the financial statements of a company. Okay. I think that's pretty good. Alexandra, you're okay with this? Ying, okay? Melissa?
Quick question.
Sure.
For the example you showed tonight, you're going to post that under week 2?
Yeah, as soon as we're off tonight, I'll post it to week 2. You'll see it right
Okay.
there.
Perfect. Thank you.
Victoria, okay? Mr. Zhang, you're okay? Carlos, Laura, you're okay?
Yes, sir.
All right. So you have your work to do this week. If you need extra time, just let me know and you can post it after Sunday at midnight. Don't anybody freak out on Sunday. Oh, I gotta get it in on time. I'd rather have you do quality work instead of rush work. So if you need extra time, take advantage of it. It won't hurt you at all. So now you're beginning the first step as accountant, as the accounting portion in this class, to record business events and also to properly present those events that make sure they're all in balance. I will post this video of our class tomorrow morning. It takes a few hours for it to process. And then if you have any questions in doing your assignment, you can always go back and refer to this video. Okay, you guys are doing great. Let's hopefully you all get this assignment and we move on to our next work next week. All right. Thanks for coming. Stay cool and we'll see you next Tuesday.
Thank you. Principal.
Adios.
Thank you.
Thank you.
Bye-bye.
Thank you, sir. Good night.
Good night.
Right.